Every year, the copper industry gathers in Santiago, Chile, for the annual CESCO Industry Week. As in past years, the focus was very much on China, but this time it was a question not of how fast the economy was going to grow, but whether slowing growth there and a clampdown on the shadow banking sector might unravel financing deals. The general consensus was, don't panic, yet. Analyst Max Layton at Goldman Sachs said the deals will probably unravel slowly because the investment in them is so closely linked to China's monetary supply system. Then there was the question of the surplus.
I think we've got a bit of a range-bound activity. There's not much upside, definitely in 2014, because we're moving into the real surplus in H2, moving into a bigger surplus in 2015, so that's a little bit bearish for copper.
How much copper are we actually talking? 300,000 to 400,000 tonnes was the general consensus. The overall mood, therefore, wasn't as bearish as the sell-off in prices during the first quarter suggested.
The fall in the copper price over the last month or so has probably been slightly overdone. We are expecting downward pressure on the copper price this year, but we're still forecasting an annual average price for the year in excess of $3 a pound.
Most people seem resigned to a market around last year's pricing levels, with an improvement out to year-end. So what was the view of the market by the end of the week? We asked a few people.
I think that the thing I'm most confident of in the foreseeable future is the continuing growth in demand for non-ferrous metals in general and copper in particular, as far as China is concerned.
I'm quite optimistic about the copper market in the short term, given the recovery in the developed economies now underway, and in particular the strong investment growth and strong growth in durable consumption, which will support the demand for copper going forward.
That's CESCO in Chile over for another year. But CESCO will hold another huge event in Shanghai in November. See you there.